The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program set up in 2003 and is currently overseen by MAS, Monetary Authority of Singapore, and MOM, Ministry of Manpower. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Understanding bonds. This is the second video in a series of 2 on understanding bonds. In this video, we will consider the benefits and risks of bond investing, credit ratings and considerations when investing in bonds. Why invest in bonds? For security, in any jurisdiction, the bonds issued by the government are considered the lowest risk of any issuer in that market. All others are riskier to various degrees. For capital preservation, with bonds, there is assurance of repayment of face value at redemption, so long as the bond is not in default. For potential capital gain, some invest in bonds to trade for capital gains when bond prices rise, especially during periods of falling interest rates. To generate regular and steady income, most bonds pay regular coupons which provide income over the period of investment. For diversification, when bonds are combined with other risky asset classes, for example equities, they reduce overall portfolio volatility or risk. What are the risks of bond investing? There are several risks, but the most important is default or credit risk, which is the likelihood that the issuer is unable to pay. Credit ratings agencies like Moody's, S&P and Fitch are employed to provide independent assessments of issuers' ability to meet their bond obligations. For example, a AAA or AAA rating from Moody's means the issuer is least likely to default, in which case the bonds can be considered high investment grade. A BBB or BBB rating from S&P means there is some chance of a default, in which case the bond is considered to be of medium investment quality. At the other extreme, if a bond receives a C or D rating, then it means the bond's issuer could be on the verge of defaulting. In addition to credit risk, bonds are also subject to interest rate and inflation risks. If interest rates are expected to rise, bonds may become less attractive, in which case investors will sell them, resulting in their prices falling. Inflation also poses a risk to bonds, especially if the rate of inflation is greater than the bond's coupon, in which case the bond's real rate of return will be negative. Currency risks. If a bond is denominated in a foreign currency, movements in the exchange rate could adversely affect coupon payments and therefore the bond's returns. Liquidity risk. This is the risk that a bond will be difficult to sell at a reasonable price at the time of sale. In other words, the risk that the bond is not actively traded. Issue-specific risk. This requires consideration of the features of a particular issue. For example, is the bond a zero-coupon bond? Does it have any repricing features? And is the coupon fixed or is it floating? In addition, do be aware if the bond has any issue-specific features, like being subordinated with respect to other sources of capital. Reinvestment risk. In Video 1, we covered callable bonds, which give the issuer the right to redeem its bonds at par value before maturity. Since this is usually done when interest rates fall, it means that bondholders will have to reinvest their funds at a lower interest rate. How are risks reflected? Credit ratings are important as they provide investors with an independent assessment of the creditworthiness of a bond issuer with respect to its debt obligations. A good credit rating can help secure a lower rate of interest for the issuer and at the same time provide assurance to investors that the issuer can pay in full and on time. However, not all bonds are rated, as the issuer has to pay fees to the ratings agency. It is not compulsory, and it also may not be cost-effective for smaller and infrequent issues meant for a domestic market, which may already be familiar with the issuer. Furthermore, ratings are based on information available at the time the rating is assigned and are subject to revision or withdrawal. As an issuer's creditworthiness can change quickly, there is no assurance that any revisions to the ratings will be made in a timely manner. It is therefore important to note that credit ratings have their limitations and should not be your sole consideration when deciding whether a bond should be included in your investment portfolio. They are only statements of opinion by the relevant credit rating agency and are not recommendations to invest. You should find out more about the issuer, profitability of the business, and track record of prior bond issues, if any. This will help you to examine if the company is able to meet its debt obligations, including the bond you may be considering. How are key credit risks usually measured? Some useful financial credit metrics that you could look out for are debt-to-equity ratio. This measures how much debt an issuer is using to finance its assets and operations, as compared with the issuer's equity. A high level of debt suggests higher risk. If the debt-to-equity ratio is more than 2, it means that to finance its operations, the issuer has more than twice the amount of debt compared with equity. Debt-to-operating income ratio. This indicates the ability of a company to pay its debt using operating income. A higher ratio suggests that the company may have more difficulty servicing its debt. A declining ratio is better than an increasing one because it implies the company is paying off its debt and/or growing its earnings. Interest coverage ratio. This reflects how many times the issuer can pay interest on debt obligations using its operating income. A lower interest coverage ratio means a weaker ability to cover interest obligations using its operating income. If the ratio is less than 1, it means that the issuer does not earn enough to cover its interest expenses. Operating profit margin. This measures operating profit as a percentage of revenue. This shows the proportion of revenue left after the issuer pays for operating expenses, which can be used to pay for fixed costs. The lower the operating profit margin, the higher the risk of the issuer not being able to pay its fixed costs. Free cash flow. This is the cash that a company has after spending money to maintain or expand its assets. An issuer with a profitable and well-managed business should exhibit positive free cash flows consistently. You should compare the credit metrics of an issuer with those of other similar entities, as financial ratios vary across industries. What are interest rate risks? In bond investing, we also need to take note of market risks. The main market risk is a change in the interest rate outlook, as this may result in a fall in bond prices. When interest rates go up, the coupon rates that were fixed historically at lower levels will look less attractive, causing investors to sell their bonds and bringing prices down. When interest rates go down, the reverse is true. This means that bond prices and interest rates move in opposite directions. This also means that factors that affect interest rates in general will affect the prices of bonds. These would be mainly macroeconomic factors, such as the state of the economy, inflation, unemployment, international trade, and government fiscal and monetary policies. What else drives bond prices? Like any other investments, bond prices are also affected by major market events such as Brexit, the global financial crisis, and the COVID-19 pandemic. Also, central banks tend to raise interest rates to try and slow demand and spending when combating rising inflation. Bond price volatility. We know that bond prices and interest rates are inversely related, but it is important to note that not all bonds react to the same extent when interest rates change. Some bonds are more sensitive or volatile and have larger price changes, while other bonds are less volatile and undergo smaller price changes. Bond price volatility measures how much the price of a bond changes when there is a change in interest rates. The volatility of a bond depends on two main factors: maturity and coupons. Longer maturity bonds are more volatile. One way of thinking about this is that more time means more uncertainty as to the direction of interest rates. It also means more chance of the issuer encountering problems that could affect its ability to meet its bond obligations. Lower coupon bonds are also more volatile. If a bond pays a high coupon, it may not be that badly affected when interest rates rise. However, if it pays a low coupon, then its price fall could be significant when rates rise. If an investor expects interest rates to go up in the near future, he should sell volatile bonds, and if he expects interest rates to fall, then he should buy volatile bonds. Longer maturity implies higher volatility. Earlier, we said that longer maturity bonds are more volatile because more time means more uncertainty. They are more volatile also for the following reason. If bond A has 1 year left to maturity and bond B has 20 years left to maturity, then assuming everything else is held constant, if interest rates go up by 0.25%, the market will adjust the price of bond A down 0.25% for 1 year. However, the market will adjust B's price down by 0.25% for 20 years, which is a much greater quantum. Hence, interest rate changes have a much greater effect on longer-term bonds. From a portfolio mix perspective, if interest rates are expected to go up in the near future, a bond investor should hold more shorter-dated bonds so that the price falls will not be that large. If interest rates are expected to fall, then the investor should hold more longer-dated bonds to benefit from greater price rises. Lower coupon implies higher volatility. Earlier, we said that lower coupon bonds tend to be more volatile and their prices will fall more when interest rates rise or are expected to rise. Here's why. If bond A pays a 2% coupon and bond B pays 4% coupon, then assuming all else is held constant, if interest rates go up by 0.25%, the market will adjust prices of both bonds A and B down. But a 0.25% adjustment has a greater impact on a bond that pays a 2% coupon than a 4% coupon. Hence, lower coupon bonds are more sensitive to interest rate changes. From a portfolio mix perspective, if interest rates are expected to go up, a bond investor would be relatively better off holding higher coupon bonds versus lower coupon bonds, as the price fall would be smaller. When buying bonds, consider how they meet your investment objectives and fit into your portfolio. Concentration risks. Diversify and don't simply go for higher yield. Diversify by investing in different issuers, maturities, industries, geographical regions, and so on. Monitoring your investments closely and paying attention to news that could indicate a possible future default. Here is a comparison and summary of different bond products. When a bond issuer is in financial difficulty, it may have to undergo a debt restructuring in order to pay at least some of its debts. If not, it could face winding up action, in which case it will be placed under judicial management. Bondholders should try to get organized and collectively seek legal advice. Approach their financial advisors to learn about available options. Approach the institution that arranged the bond issue. Seek help from the Securities Investors Association, Singapore, or SIAS. If it's early enough, consider selling out of the bond. Here are the key takeaways. Bonds are bought for capital gains and passive income. But like all investments, they come with risks. Credit ratings are useful in evaluating a bond, but they should not be the sole factor. Long-dated bonds with low coupons are the most volatile. Conversely, short-dated bonds with high coupons are the least volatile.